Hi, I'm Dryden Pence, and today is May the 11th, and it's 11:16 in the morning. I'm going to talk about a variety of things. Certainly, the market has been exceedingly volatile and certainly gives concern for many people. My mission here is to give you some perspective on what's going on. Talk about this volatility, talk about actions and things that are happening, what do we see going on in the future, and why the market may be somewhat unsettling at this moment, and how you should think about it, and give you some suggestions and perspective going forward. So I'm going to talk about market volatility, of course. I'm going to talk about the war and oil, inflation, interest rates, unemployment, and valuation. But before I start that, I want us to have some perspective. I want you to go back and think about what life was like in 2020. So it was back in 2020, back when the market was right about the same space. Okay, that was in the period of time, November, December, January in 2020. What was going on at that moment? At that moment, we had COVID, we had lockdowns, we had 30% plus unemployment. We had an idea about the future that was very, very bleak, because not only that, our neighbors were threats to us. They could give us a disease that might kill us. Okay, our economy was being propped up by massive amounts of stimulus. Nobody knew if they'd have a job in the future or how bad it was going to get. Those were very, very bleak times. And at that moment, what you could look forward to was pretty much very, very bleak. No one knew what was going to happen. And the market went down very, very quickly. Okay? And then as things worked out, it began to recover. Now I want you to fast forward to today. So in 2020, the market sold off because everything looked really bad and the economy looked horrible. Let's move forward. Where are we today? The market is sold off very aggressively for the exact opposite reason. The economy looks good. I know that may be kind of confusing, okay, and unusual, but it's actually true. Why did the market sell off? The market's selling off because expectations about inflation and higher interest rates, compounded by issues of a war and things like that. But the issue here is, why do we have inflation? We have inflation because we overstimulated during COVID. Why do we have fear of interest rates being raised? Because the economy is running too hot. So I want you, as I go through this presentation, I want you to think about the same last time we were in this space, because everything looked horrible. This time when we're in this space, it's because actually the economy is too strong. And people are worried about the government reaction to that. It's a very different set of circumstances. And I want you to keep that in mind as we go through this. Now, if you take a look year-to-date index performance, obviously the NASDAQ is down and the S&P are both down dramatically. Well, if you think about going back to COVID, you saw a period of time where the NASDAQ and the S&P both went down very dramatically, all right, similar levels, a little worse, and then they bounced back very quick, right? We had about 126 market day round turn. Now, I want to be straightforward with you. We don't see a recovery from the current sell-off being 126 days. It's going to take a little longer. These things take a little longer because what's going to improve this are economic fundamentals and the fact that so many people who were on relief or getting transfer payments now actually have jobs. It takes a little longer for the real economy to generate a positive market than it did the artificial economy of big transfer payments like we had in COVID. That's the important thing I want you to remember. During COVID, everybody was getting transfer payments, right? They weren't getting paid a salary, we as taxpayers were giving everybody money to survive on, and they were getting $30,000 plus years in some cases. Now, all those same people that were getting relief, the majority of them now have jobs. And incidentally, those jobs are not, month to month, but they're longer term. And they have brighter expectations than just when is your next relief check. These are important perspectives to keep in mind as we think about how we get through this. So, let's talk about market volatility. Why is a market this volatile in a time where the economy is actually doing better? Well, let's talk about some volatility historics that have gone on now. As you can see, this is the ninth time we've had these big sell-offs since 2015. Okay, these sell-offs are not something that are completely unusual. They happen with actually reasonable regularity, but we tend to forget them, right? You tend to forget pain, right? So what happens is, this is the ninth time that this has happened, but I want you to pay attention. The amplitude is increasing. The amplitude increases. So you have a sell-off and you have a recovery. You have a sell-off, you have a recovery. You have a sell-off, and here's where we are now, looking for when does it get better? The amplitude is increasing for a couple of very specific reasons, so I want to share that with you. Part of this is the nature of the markets have changed a little bit from what we remember 10 years ago. If you go back to 2010, about 10% of the market were retail investors. People with their Ameritrade account, people working on their own keyboard, trading their own individual account however they wanted to. Fast forward now, that number is closer to 20%. And this is this GameStop thing, the meme stocks that came in first quarter of 21 when it got up to 24%. Basically, the retail participation in the market has doubled. I have a question for you. Are retail investors completely rational? As a matter of fact, is everybody you know completely rational? No. They tend to invest on emotion. All in, all out, all in, all out. Buy this because it's going up. Sell this because it's going up. But they overreact. Now, here's the issue. We kind of gave the children sharp objects here. This is what happened. We gave people the ability to trade their emotions into the market. That's the equivalent of getting children sharp objects. And then we gave them Red Bull because people took their stimulus money and they took more money that has gone in just in this short period of time than went in the previous decade, right? So we gave them a ton of money, and what did they do? They threw it in the market. And they created this massive volatility because here's one thing that happens, right? When you're back here and only 10% of your market is trading on emotion, it doesn't push the algorithms. And there's a lot of algorithms that are computer programs here. When it moves up to 20%, now the emotion of people that may not have been through this, may not have been thinking clearly, are just betting on whatever they feel today. This is enough to begin to push the statistical algorithm. So this is where you get these moments in the market where a little move turns into a big move. Because computers take over and are trading off the same type of emotional volatility. This is an important thing to remember. So the nature of the markets have changed a little bit. And as an end result, here's what's happened. This is an estimation that's been done from Morgan Stanley. And basically what they've said is that most of the retail flows, most of the people that threw all their money into the market because they got all this COVID stimulus, and the retail traders that are jumping in, jumping out, jumping in, jumping out, they pretty much lost everything they made. It's an important thing to realize. If you're trying to follow the all in, all out of the retail investors, or if you're panicking around that, this is what happens. They've lost all of it. So it's an important thing to pay attention to. Now, I want to give you some perspective as to why it's not a good idea to try to time the market. If you look at timing the market being perfect in, perfect out, or all in, all out, here's what happens. Okay? If you were fully in, now this is over a 30-year period of time. 30-year period of time. If basically you stayed fully invested, the S&P 500, your average was up about 9.9%. If you just missed the best day of the market, the best one day of the market, you ended up 6.1%. If you missed the best 2 days, you ended up only 3%. And if you missed the best 3 days out of that period of time, you were up 0.3%. Trying to time the market, okay, basically puts you in a situation where if you miss the best 5 days in the recovery, you're down 4.1. You miss the best 10 days, you're down 12.6. And you miss the best 20 days, you're down 24%. So the important thing is not timing the market, but time in the market. And there are moments when it's going to be incredibly uncomfortable. I understand that. There are moments when you're flying on an airplane that's massively going through turbulence that are very uncomfortable. Understand that. But the vast majority of the time, everybody gets to their destination. And so you're looking at these points where you have to recognize that it may be an incentive, that you may be thinking about, gosh, I got to get out. I can't take the pressure anymore. The point of the matter is there are things out there that can help answer that question as to how long and how worried do I need to be about this. So I want to take the emotion out of this, and I want to focus on the facts and what we have to look forward to going forward. Because as I said in the beginning, where we stand right now, although the market looks ugly, where we stand right now, forward looking, is an extremely much brighter position than it was when we were here in 2020, when all you could look forward to was an abyss. Now, let's move on. Here's the facts. Remember, earnings drive the price of the stock. Earnings are the fundamental characteristic of the price of the stock. And if you look at most of the reporting, 436 out of 499 components of the S&P 500, 67% are beating on sales and 78% are beating earnings expectations. 78% of the time, companies are doing better than everybody expected them to do. That's not a bad result. That's not a bad result. And looking forward, because if you basically put on your blinders and looked at that number, you would say the market ought to be really good. Take a look at this, operating margins. Here's operating margins back in 07 and 08, right? Look how far they went down. Here's the operating margins of 2020, and here's the operating margins now. Vastly different. Vastly different. So operating margins are up. There is some predictions that they will be going down, but even if they go down just a little bit, they're still vastly above where they were. They're kind of back to the operating margins that they're at prior to the pandemic. So if we look, take some of the emotion out, and we look at the facts, we find the things that drive earnings of companies are still remarkably good. Remarkably good. And so what does that mean? Rising earnings estimates. We still are looking at rising earnings estimates for each of these companies. So when you look at the fundamentals, while emotion may be going, oh my gosh, it's scary, interest rates are going up and there's inflation, reality is the things that drive the fundamental driver of a real valuation are still pretty darn good. Now let's talk about the things that are creating some of these moves and what's creating some of these underlying issues. Well, here's the first one, the war. Some of you have seen this slide before. The Russians got their tanks stuck in the mud. And then they used artillery to try to level all of the cities. Now, what's happened since my last video is the Ukrainians successfully defended Kyiv. It's a big, important move. And the Russians decided they could not take Kyiv. And so they moved all of their activity to the eastern part of the country and are trying to secure the Donbass regions, right? Now, here's a couple of things to recognize. And you've seen these pictures of the tanks and the things that blow up. And the point is, Ukrainians have done an excellent job. But now the war has changed in character so that the Russians are kind of defending and the Ukrainians are in the counterattack. What's the difference now? The difference is NATO and the United States are now giving the Ukrainians the weapon systems that they need to counter Russian artillery. It's very important. Okay? Artillery beats artillery. Artillery is what that's the only thing the Russians do well. And it's what they were using to level these cities. That's Mariupol and things like that, just tons of artillery. Now the Ukrainians are getting weapon systems that, without going into great detail, allow them to counter battery fire with great effectiveness. And that will help turn the tide of the war and put the Ukrainians in a position where they can be effective in these western regions and move this to some sort of additional resolution. That's important. It's important because the humanitarian cost that is going on in the Ukraine, and we see all of that, and that is an awful, awful thing. But it's also important because wars end. And the sooner this one ends, the better for everyone. What does it happen to, from an economic standpoint, what caused everything to get worried about the war over and above the humanitarian issues of it has to do with oil, right? So we pulled about 3 million barrels a day off the market. That has created some shortages of expectations, and basically the prices have gone up, right? Now here's the thing to know. In the United States, when oil prices get north of about $4.40, you begin to see demand destruction. You can see it. I've always said, Bubba turns to Leroy and they say, we're taking your truck today. And you take a 14 mile per gallon truck and you turn it into a 28 mile per gallon truck because it's carrying 2 people. And the point of the matter is when oil prices get up this high, demand destruction begins to occur and they begin to go down because people's behavior changes. You're beginning to see that. You've probably seen it at the pump. So month over month, we're beginning to see some changes. Year over year, it's still very high. Month over month, we're beginning to see some changes. Why is this significant? It's significant because gasoline prices figure into CPI, they figure into inflation rates, they figure into all the numbers that the Federal Reserve looks at about how high they're going to raise interest rates. Remember, the Federal Reserve is trying to raise interest rates because they're trying to slow down the economy. They don't raise interest rates when the economy's bad. They raise interest rates when the economy's good, and they're trying to slow it down. It's a very important distinction. My point here is that gasoline prices are going to do some of that for them. And also, we look at oil prices probably in this 90 to 110 range for an extended period of time. Now, what happens, what's important to recognize is when does this get better? We are not seeing, remember if you go back 60 days ago, people were going, oil's going to go to 125, oil's going to go to 150, and they're trying to panic everybody. And that fed in to these inflation expectations that we have. Well, but the point of the matter is the math is not there to make that happen. A $3 million barrel a day reduction in oil doesn't give you 125 oil. Okay? We're at this range where we think oil will be staying. And when does it get better? When does it stabilize? When does it get better? Well, when you replace the 3 million barrels a day. That's what happens. So here's the issue. We peaked back prior to the pandemic, we peaked at about 13 million barrels a day of production in the United States. And as you can see, we're increasing our production now in response to this, but it takes a little while for us to ramp up our production to that. But the United States alone, okay, can create about 1.5 to 2 million barrels of the shortfall ourselves. That's significant. Now, OPEC could fix this in a day or a week anyway. They could turn on excess production and come up with the 3 million barrels that we're missing. The point of the matter is they're not going to do it. They're not going to do it for political reasons. The 2 players there are Saudi and UAE, and they don't like the United States right now. Okay? They don't like the United States right now because we're trying to make a deal with Iran. And the short answer is they're not going to help. So something that could solve this oil problem very, very quickly is probably not going to occur. So what's the point? Everybody wants to ask me, when does it get better? Our estimation is 1 to 9 months, right? It could happen in 1, but it's probably not going to happen. More like 9, because 9 months is when the U.S., we have enough time to increase our daily production back up to about that 13 million barrel a day production level. And that will really improve both in the U.S. and global markets. So it's going to take a while for this oil thing to get better. But it does get better. And that's material. It affects inflation. It affects everybody's pocketbook. So the point of the matter is it does get better. It just takes a little time. Let's talk about the other thing that's moving around inflation. If you've been trying to buy bread or eggs, you've noticed that those products have gone up significantly, right? So let's talk about bread. Well, the problem is that Russia and Ukraine account for about 25% of the global grain supply. And that is temporarily constricted, all right? Russia because of sanctions, Ukraine because of war. So we're going to see elevated bread prices for a little while, okay? Again, these things gradually come to an end because what do farmers do? They change the crops that they have planted. So you're going to see more wheat planted this summer by U.S. farmers who are the most productive in the world, right? Because they're getting higher prices. It takes a little while for these things to adjust. My point here is the things that are creating the problem all get better with time. We just have to think about how long. So we have basically a crop season that we have to work with here. We're going to have elevated grain prices for crop season. Okay, some of these things are going to be important. You're going to have elevated ag prices, right? And a lot of that is just because of transportation costs, right? That's going to become elevated. And then also you can begin to change the production thing of the chicken houses, things like that. That takes a little bit longer than everybody thinks. But the important thing to recognize is that global economies and agricultural products and commodities do adjust over time. The important thing is time. Russia is a big supplier of a lot of key things. We're going to have to find alternatives because they're going to keep these sanctions on for a while. I mean, Russia is no longer part of Europe. It's no longer part of the Society of Nations. And that is a way of punishing them for this horrific thing that they've done. Okay, so we all are going to be sharing in that, but it is, in a sense, the right thing to do. And we're going to look at inflation, and inflation is going to be by sectors, right? It's not all one thing all at once. And the important thing that we're seeing here is inflation in the service sector. We see some inflation in energy prices, right? We've already talked about that. But we're seeing inflation in the service sector, and that's about wages, right? And I've talked in the past about when you get these rapid increases in wages in certain sectors of the economy because of basically labor shortages, now you begin to see technology begin to bring those costs down. How long is that going to take? It's going to take a while, right? But think about next time you go into a McDonald's, do you have the kiosk that you order from instead of the individual? You're beginning to see technology begin to help lower some of the cost and the inflation in those wages. Again, this takes a little time. To summarize this, right now, inflation expectations are pretty high. This is a combination of all that stimulus and the adjustment period or the transitory nature of all things. I think people have finally realized that there's real inflation in the market done to all of this stimulus and the monetary phenomena, and there's some inflation in the market due to supply chain constraints. But the important thing to recognize is expectations that are peaking now. We just got an inflation data out today, and inflation has last month was, or a month and a half ago, was about 8.5%. It was very high, right, on the headline number. And that's beginning to come down. The core is beginning to rise. And the point is it's not continuing to go up. Very important to understand on all of these numbers. In order for the stock market to turn around, the news does not necessarily have to be good. It just has to be less bad, because that's the beginning of a trend. The stock market is kind of discounting and looking at the market and the economy and stuff 9 or 10 months out, right? And people reacting to that very quickly. They react in an hour to something that may take a year to happen. So the point here is, as you say, when is this going to end? When am I going to begin to feel confident again? When are people going to stop being so negatively emotional? Because what's going on in the stock market here, most of this is driven by sentiment, not earnings. I showed you that the earnings are doing pretty good. It's just sentiment has gone bad. When does sentiment turn? Sentiment turns when people can begin to feel like things will be getting better. So again, things don't have to be, the news doesn't have to be good. It just has to begin to be less bad. We're beginning to see an opportunity for that in inflation. I can't sit here and tell you that we're not going to bounce around at a very high inflation rate for several months here through the summer. But we're beginning to see an opportunity for that news to get a little bit better. The rate will begin to go down. And that's going to be a positive thing. And most expectations now are saying still in 2023, inflation rate's going to come down dramatically, and it's going to be somewhere here. We actually kind of think we're about 4. I'll get to that in a second. So you can look at household expectations, right? People's expectations went way up, right? So here's what it is. They think that next year, well, a year from now, it's going to be around 6, but when they look at it in 3 years, it's around closer to 4, right? So the point of the matter is when you ask, when does the news get better? The news begins to get better as we get later into the year, okay? Probably fourth quarter, I don't know. But third or fourth quarter, second half of the year, when basically what we're going to begin to see is maybe we've peaked out on inflation. So watch for that word, watch for peak, right? And we start talking about peak, then that's actually a good thing. We've had peak inflation because after you peak, what do? You begin to go down. So that's when you can begin to see some of the things turn. Housing is still a big issue, right? Housing is going to be the sticky one, all right? Gas prices can go up and down pretty quick. Housing is going to be sticky, right? And so that's one of the things that you're going to see housing costs and shelter be a very persistent number here and stay elevated for a while. Right? You know, you're beginning to see the price of the housing market cool off a little bit. You can see these components. Shelter is the largest component of the CPI. And so what's important is you begin to see these numbers begin to fight. And we talk about cars too. When you look about used car inflation, remember when this first happened, used cars went way up in value. Now that's coming back down. So I'm going to come back to the shelter thing a little bit later, but I want you to remember that it is a persistent piece, and that's one reason why we think inflation is going to stay elevated for a little bit. But we're already beginning to see some modulation in home prices and sales. So this is the other thing. When you look at used car inflation has gone down. New cars have gone up, right? Because people they're able to push through a price increase, right? They do a surcharge because they can't get them all, right? But used car prices, what's happening here is people just had to have a car. And there weren't any available due to the supply chain, so they had to pay whatever they could pay for a used car. Well, that case is not the case anymore, right? We are beginning to get new cars into the market, right? So the used car prices have fallen. And this is a big factor of inflation. So when you think of the math that goes into this, you see this is one of the things that is improving. Now let's talk about supply chain. If you remember, we talked about the supply chain and the problems that we had. These were the container ships, and if you looked at my previous videos, I was talking about, hey, they said they solved it, and what was showing up in the Long Beach harbor, fewer ships, but they just moved them 40 miles offshore. If you remember, I showed you the satellite view on that. But the issue is this has improved. Okay, it's still a little volatile, but it has improved significantly. This means that as far as the inbound freight, our ability to process things coming into this country, we're in a much better position than we were back in January, right? And that has improved dramatically. Now, there are big challenges in Shanghai coming out of China. We're going to see these moments in the supply chain where it looks kind of like the old pig in the python picture. But the important thing here is, at least for the U.S. domestic, we're beginning to see improvements in the supply chain where we're able to handle the inbound and clear out some of those things. So that portion of inflation in the supply chain inflation is getting better. Again, these things take time. These things take time. And indeed, when you look at the global supply chain pressure index, you're beginning to see an improvement. Bottom line here, let's talk about inflation. How high for how long? When we add this all up and we take a look at it, here's our best guess. How long do we think inflation is going to be over 4%? Probably at least through 2023. Some people think it's going to get below that. Our opinion here is that we think we're going to be over 4% through 2023, but we're going to be below where we are now. So the trend is positive in that sense, right? So what it means for the market is the market, as the market begins to see this expected inflation go down from 8.5 down into direction towards 4, the market's going to look at that and see that as a positive because some of the things are beginning to straighten out. So why does all this inflation stuff matter? Well, it matters for two things. Individual's pocketbook, and it really affects people at the lower end of the economic spectrum even more, right? So that is a very big issue, right? Inflation is something that we want to try to control. The fact is that the Fed wants to control inflation. And what are they doing? They're saying the economy is too hot, so we're going to raise interest rates to slow it down. The economy is doing too well, and that's why we're raising interest rates to slow it down. So if you want to look at massive government policy, do you want to be in a situation where you're looking at massive government policy helping you because the economy is too bad? Or do you want to see government policy interfering because the economy is too good? I think I like where we are better, and that's important. So let's take a look at this interest rate issue and what the expectations are. As you can see, here's the thing that most people forget. We've been through these rate tightening cycles before. This isn't new. This happens over time. As a matter of fact, when we look at 2016 to 19, the Federal Reserve raised interest rates, by 25 basis points 9 times. They got up, the federal funds rate was at 225 or 250, right? And people forget that because COVID came along. So we're at 250 before COVID. They had already pulled off a 25 basis points and then a 50 basis points. They pulled 75 basis points out of the Federal Reserve federal funds rate prior to COVID happening. Why did they do that? Because they realized they had raised too much too fast. And they were beginning to see big changes in housing prices. So they overshot. And they came back down to 175, and they were trying to figure out, is 175 the right median rate? When COVID hit and they dropped it to 0. My point here is that most people are looking at expectations of the federal funds rate being at roughly 3% by the end of the year. Well, that's 75 basis points higher than the last time they had to stop raising it because they had overshot. My expectation here is they could get to 3, but if they do, they'll probably be looking at a system where they'll need to back down. So we're looking at 50 basis. We just had a 50 basis point increase, right? We're there. So we're at 75. We got a 50 coming up in May. We'll probably have another 50 in June, right? So then we'll be at 175. And then the question is, what do you do for the rest of the year? Well, one of two things are going to happen, right? They're going to start thinking about the word pause, or they're going to go, well, instead of 50, we're going to go 25. That move is positive because that means they're closer to being done with the rate hikes, and certainty begins to come into the market as to where this is going to be. Remember, the market reacts to uncertainty. And the more these issues clean up as we get deeper into this year, the better off we will be. Now, remember, I talked to you about, we've been here before. Here's what happened. When you saw home mortgage rates get north of 4 and headed into 5, demand fell off dramatically. Well, we're already seeing that. And this is why the Fed took it from 250 back down to 175 prior to COVID. Right? So what happened is you got the reaction out of the public that you wanted. If you're the Fed governor, you got the action out of the public that you wanted at a lower rate than you expected. Now we're seeing, even though they just raised rates up to 75, we're seeing home mortgages up high enough that they're reaching this moment where demand is falling off dramatically. My point here is that they're beginning to see the reaction that they expect at lower rates than they had. Which is why I don't put a lot of credence in people saying that the federal funds rate is going to go to 4 or 6 or 7%, right? I think that they're going to be in a position where they're going to get the reaction they need at a lower rate. And this is one reason why. I call this the housing PE. You look at housing prices. Everybody looks at the housing market, and prior to this, they're going, it's a hot market, it's overinflated, it's too high, but everybody was doing it, right? Because money was cheap, and it was pushing housing prices up. But when you add the interest rate on a mortgage to the house price together, and you get a moment where 33% of someone's income, the median income, is going to buy a house, demand falls off. It becomes just too much. So as we see this increase in shelter costs, you're beginning to see it reach the price at which demand begins to fall off. You're going to see a reduction in demand for houses, and you're probably going to see a reduction in what people are willing to do rent as they move around. It's going to be harder for people to push that through. And rents take a little bit longer to change than other pieces of the commodity price, because a lot of times they're stuck in leases that take a little longer. So it's a 1 to 2 year adjustment price. But this is the thing that's important to watch for. When you begin to see housing costs, shelter costs get to be 33%, then you begin to see these declines occur in housing prices. Demand backs off. People can't afford it, right? So let's talk about this big thing. How much will the Fed raise interest rates in June? Well, we're probably looking at 50 basis points, right? And how many after that? Maybe 4. So we do believe that the Fed's going to raise interest rates. The question is, when do they stop raising interest rates, or when do they go from a 50 basis point rise to a 25 basis point rise? That moment, or when you hear the word pause, that's the moment where the news starts being less bad, and you begin to see a market improve. And again, they're going to be looking at this and be data dependent around this, okay, at every meeting, right? The last meeting they had, when Chairman Powell came up and said, no one is seriously looking at a 75 basis point rise, right? The market reacted very favorably to that because people were worried that there were going to be a 75 basis point rise. There's enough meetings and enough things going on. They can do 50 at a time and then wait and see, because they're already beginning to see reactions to these things. The other side of it is oil is going to be part of the Fed's job for them. The objective is to slow down the economy, right? Oil prices go up, more people spend more money for gasoline, they're not spending it on anything else. And so the Fed is always trying to raise interest rates. Well, when they raise interest rates, all the money just goes to the banks. But oil prices, it's going to the energy companies. But it's overall having the same effect. It's lowering overall demand in the economy. Why? Because the economy is moving along too well. Let me talk about that a little bit. Let me give you some perspective as to really where we are, because this is a fundamental important issue. We are very much back, very close to being back to where we were in total non-farm employment at the beginning of the pandemic. Right here, we're almost back to where we were. That's important. And we're actually seeing that we have labor shortage. We've got more jobs open than we have people wanting to work. This is recovering very, very fast. As a matter of fact, this is the fastest recovery in the main employment age, 25 to 54. This is the fastest labor force recovery that we have had. Now, we're not recovered completely. We got a little ways to go. But take a look at the speed compared to the 2000 peak and the peak in 2007. We've recovered very, very quickly. And indeed, we've got 11.5 million jobs to 6 million people looking. We got basically 1.9 jobs for everybody looking. Now, this is important. You're going to hear people talk about recession. They're going to try to scare you with the R word. I'm not saying we're not going to have one, but I want you to think through this with me. In a recession, what's the biggest thing that affects everybody? Unemployment. If we have 5 million jobs disappear, okay, unemployment then goes up by several percent. We're now 3.5%, right? Unemployment would get back up around 6 or so. I mean, you would begin to see that effect, and people would be worried about unemployment. Well, currently where we stand, if we have a downturn in the economy, if we begin to see things slow down, all we're doing is losing jobs we don't have anybody to fill anyway. So what I'm trying to point out here is that the fundamentals of the economy are sufficiently strong enough that we can withstand a contraction in response to the Fed's activities and still find ourselves at a very significant employment level. And that's very important. That's very important because that still means we got a very strong economy going forward. Again, like I said, 1.9 jobs for everyone looking. Now, one reason why we have this, I want to give you some color on this. I know this is a longer video than I normally do, but I think it's important, is that here's the facts around what happened during COVID. During COVID, if you look at median statutory replacement rates for wages, we as the taxpayer subsidized folks to the point they were making more money not working than they did working. They were making more money not working than they did working. And we did that in response, very justifiably, to all this uncertainty in front of us. Remember, go back to November of 2020. All that uncertainty that was in front of you at the time, we dumped a lot of money in because we didn't know how it was going to end. It basically ended up better than everybody thought. But for the longest of time, we were doing this. So what happened? And you just remember how this number looks. What happened? We bounced off here. This is labor force participation, seasonally adjusted, right? So the whole time that we were paying people more money not to work than to work, did the labor force participation rate go up? No. Why should it? When that began to go, what happened? And all that extra stimulus goes away. People start going back to work. Now you're beginning to see changes here because, and I can go deep into this, but you begin to see changes in this thing for younger people who are in and out of the workforce, and for older people who are within 2 years of retirement, of going on Social Security. Because what happens is their unemployment, they've worked enough to get unemployment again, and they just go on unemployment early. And then they retire and go on Social Security because the unemployment benefits and Social Security are almost the same for many people. So this is why you're seeing these variances. But I want you to pay close attention here. If we just got back to a labor force participation rate of what we were at the beginning of the pandemic, right, we would have more people work. We'd have over 160 million people working in this country. That's a lot of folks earning money. And also, I want you to remember, people during the pandemic were getting transfer payments that were frequently, in some cases they were getting more, in many cases they were getting less. But what do you want to have? You want to have someone earning wages or somebody just sitting around. The point of the matter is our economy now has jobs for everybody that wants them. And indeed, if you think about it in aggregate, more money is being made by more people than ever before. Real wages and salaries are much higher than they were even pre-pandemic. So in the entire economy, even as you look at it today, there's more money being generated by wages and salaries. And replacing transfer payments from taxpayers with wages and salaries paid by employers is a far superior situation to where we were 2 years ago, the last time when we were looking at a stock market like this. In addition, balance sheets are much better. Okay, people do have a lot of savings. Now, that is skewed, okay, that is skewed to the top part of the economy. The people in the bottom 20%, those individuals are pretty much kind of in a situation now where they have to work. They don't have as much savings, and you're going to see them continuing to move in to the job market, okay, quite frankly, because they're out of savings. They're out of savings. They have to go get a job. And the good news is there's jobs for them. So it's very hard to have a recession with low unemployment and reasonable balance sheets. Very hard to have a recession with low unemployment and reasonable balance sheets. But what we do see is a likelihood that the Fed may overshoot and things are going to be a bumpy ride. It's going to be a bumpy ride between now and the end of the year. I cannot tell you anything differently than that. Okay, the amplitude of those bumps, I can't tell you exactly what those are going to be either. But I can tell you that the things that are causing that are all things that get better in time. The things that are causing this oscillation, this volatility, this concern in the market are all things that get better in time. We just have to be a little patient. And folks, we've been through this before. We've been through this before. And we've come out on the other side, and it's been a much better set of circumstances over time. Indeed, when we look at this, we're looking at GDP growth, percentage GDP growth was very high, and it's coming down, right? The expectation is coming down, the forecast, it's going to come back down to roughly a 2% growth. And the same kind of growth rate that we have from 2009 all the way to 2020. 2009 to 2020 was pretty good. Pretty good for the markets, pretty good for the economy, pretty good for most of the people in this country. So what we see is going back to a more normalized GDP growth. The adjustment is going to be a little difficult. When you're driving your car at 90 miles an hour, and then you slow down to 50, you feel like you're going really, really slow. But you're still moving 10 times faster than you can walk. The point of the matter is we see the economy's growth rate coming down. This is in a period of adjustment, but it still begins to move forward. It's going to be a rough adjustment, but it's going to still be in a positive place. Now, and take a look at the earnings forecast. Remember, earnings are the most important. All the earnings forecasts are good. These are not negative numbers. You're not here. You're not here where earnings are going down. Okay? You're here where earnings are still growing. A very different set of circumstances. What's happened to the market? The market was overpriced. That was clear. The market got up really peaky, right? And now it's come down to a more normalized level. Does that mean we're currently at a market bottom? I don't think I can tell you that. I don't know exactly where that is. But I certainly think that we're probably closer to the market bottom than we are to the top. But I think we're moving around this place where valuations are beginning to make some sense. And if you remember, the last time we had this downturn was back in 2018, and we bounced pretty significantly off of that, right? So we're back into a more normalized market price. And what happens after it gets to that, the history is it tends to go up. So markets have room to improve here, right? They have room to improve. The fundamentals are still exceedingly strong. The economy is strong. The economy is generating job openings for anybody that wants one, and those people that are able to go out there are able to be productive members of society and make a salary that's greater than what they had on unemployment before. Okay, the point is that they're able to move forward on that, because remember that extra unemployment was a very short-term thing. Now they're able to look forward to a brighter future. And so prices are going to be driven by earnings rather than multiple. Remember, the multiple is sentiment. Sentiment is not very good right now. And it's not going to turn until the 3 or 4 things I've talked about begin to turn. So we're going to have volatile markets. Share prices are going to be earnings driven, not multiple driven. So we've got to watch for companies that generate positive earnings and continue to grow their earnings and have margin expansion or margin maintenance in this type of environment. We're returning to a bipolar world. Globalization is severely changed, right? Russia is no longer part of Europe, and they're probably not going to be for a while, right? China is beginning to function in a different world. That's going to actually push the United States and Europe closer together, which is actually a very good thing in terms of how our economies are integrated. We're going to be U.S.-centric, okay? We are the largest, most dynamic, most recovered economy out there. And you're going to begin to see us bring home a lot of supply chain activity back to the United States, which is going to continue to be an engine for full employment in this nation. Our economy still grows, but it's going to be at a slower rate. Our economy is still going to grow. It's going to be at a slower rate. So we're not going to see these moments of really rapid growth. It's going to be a positive growth rate. And you have to remember, for the period of 2009 forward, the economy were growing at 2%, and markets did fairly well. The economy did fairly well. We're able to get back to some sort of normalized level. So what I want to share with you is this. What do we think about going forward? What are the things we watch for going forward? What are the key phrases to pay attention to that can make you feel like, wow, this is kind of a crazy place what we're at right now, but what's the future look like? And when does the pain stop? Pay attention to these things. And all these things get better in time. The invasion. So we talk about first the invasion, inflation, interest rates, and election. 4 things. The invasion. Sooner or later, this circumstance in the Ukraine, this horrible war, comes to an end. The Ukrainians now have the ability to do a counteroffensive to push the Russians out. And at some point, they get to a point where they can sue for peace on their terms. That's significantly important. And so we have to watch this very carefully, but you're beginning to see some opportunities for an improvement there. It's not going to be over overnight, okay? But you're going to be able to see a situation that moves to a more successful result for the globe. Inflation. Pay attention to the term peak. Somewhere here in the next several months, people are going to start saying, okay, it's the rate of inflation is as high as it's going to get. And now it begins to slow down. We saw some indications of that just today, but it seems like we're probably going to plateau, and you plateau, and then you move down, right? So pay attention to that, because inflation is probably not going to continue to get worse. It's going to take a little while for the circumstance to get better, all right? And I've already covered that with oil prices and some of the other things that happen. So this is the word to look for, is peak, right? So here you want to look for peace. Here you want to look for peak. And here you want to look for pause. What I mean by pause is the word here is pause, because they're going to go 50, 50, 50, and then they're either going to go 25 or they're going to go pause. At the moment they say we're thinking about a pause or we're reaching a level, that's when sentiment's going to change dramatically, because that means we're ending the rising cycle. This is important. So peace, peak, pause. And then the last one I bring up is all of these are circumstances. This is an actual date, right? You're going to have an election in November. And I'm not being political about this. There's going to be an election. You're either going to see a Republican take over of the House or you're not, right? Most people are predicting that it is. But the results of that election will be material, because it will give everybody an indication of the uncertainty around whether or not there's another big stimulus plan, right? Because there's another big stimulus plan out there, and we're already saying these issues are caused by excess stimulus. We don't need to have another period of excess stimulus, right? So that's the thing that it's interesting to people. So the outcome of the election will take that threat off the table, perhaps. We'll know one way or the other. So this is what's really important. What I really want to share with you is all the things that will make this better, that will improve the sentiment that's in the market, are things that probably begin to get better between now and the end of the year. We just sort of have to wait it out and let the system work. Between now and the end of the year, we'll probably be in a situation where we can evaluate peace. Between now and the end of the year, they'll be talking about peak inflation. Between now and the end of the year, they'll be talking about a pause in interest. So I know it's uncomfortable, and I know it's unsettling, but we've been here before. We've navigated this before. You've lived with it before. And we come out on the other side. Now we know all the elements of the adjustments that need to take place, the patience we need to have through all of this. And we can look forward to a circumstance that is worthy of what it is. Remember, as I said before, 2 years ago when the markets were doing this, the future looked very, very bleak, because you were looking at an economy with a 30% unemployment and possibly in an abyss that was going to get worse. Now you're looking into the future, and what you're able to see is an economy that has full employment, that is moving on, and that's getting government reaction because it's going too good. Vastly different set of circumstances, and ones that we should be long-term positive about. I want to thank you very much for your time. I hope this has helped give you some perspective and giving you the background for it. So thank you. I appreciate your attention. Sorry this went so long, but I hope it's been helpful. Good day.